Şimdi kriz sonrası dönemde Merkez Bankacılığı, Deneyimler ve Gelecek isimli oturumumuz için Türkiye Cumhuriyet Merkez Bankası Başkan Yardımcısı Sayın Doktor İbrahimTURHAN'ı, Hindistan Merkez Bankası Başkanı Sayın Harun Raşit Han'ı, İzlanda Merkez Bankası Para Politikası Kurulu üyesi ve Londra Birkbeck Üniversitesi Ekonomi Profesörü Sayın En Sibert'i ve Polonya Merkez Bankası Ekonomi Enstitüsü Genel Müdür Yardımcısı Dr. Markin Kolasa'yı sahneye davet ediyoruz.
Good afternoon to everybody. Well, after such a good speech, obviously I will have difficulties. But yet we will try our best to at least catch the same standard you heard a few minutes ago. Thank you, Mr. Governor, and thank you for this very, very good speech. Today we are going to discuss about the central banking after the crisis, experiences and the future. Very, very challenging topic. Me, myself, I have been attending for last 3 years the G20 meetings, and of course we have several working groups there. Lastly, I requested from Mr. Governor to forgive me from this job, because my impression is that we discuss too much and we deliver too little. So today we will contribute to discussion with the hope that finally we will get an outcome, a positive outcome. Of course, I will not benefit my position to give a pirate, how to say, presentation. I will give the floor to the very distinguished, eminent speakers. But before, I would like to touch upon very few issues, and very briefly, I promise. During the Asian crisis, I was writing my PhD dissertation. Actually, it was really funny because I started it in 1995, and I picked up the topic as how a financial crisis, a pure financial crisis, can have a contagion, can spill over real sector. Normally, until then, there was no such an issue. Normally, what you expect to see, or what you were expecting to see, is that first you have a problem in real sector, and through balance sheet channel or so on and so forth, you will end up with having financial sector having trouble. But immediately after I started this, we had the Asian crisis. And as far as I know, it was for the first time that financial sector, I pick up the Mr. Governor's terminology, really caused a crisis where there was no real problem. So this is feasible. And there, of course, this kind of financial sector may be really nasty, not a beautiful one. But after this, after the Asian crisis, there was huge discussion I'm sure you will remember. And there was an umbrella concept, a new financial or a new international financial architecture. And after the Asian crisis, countries, advanced economies, came together and decided to establish two bodies. First being G20, and second, Financial Stability Forum. Why G20 is important? Because until then, the main forum to discuss the global issues was G7. So 7 advanced countries were coming together, and behind closed doors, they were discussing issues and got a result. And we were waiting outside to get their, how to say, the point of view, perspective. And what was our task at that time? Well, to follow what was said. But then there was this understanding that the core is not enough, first. And second, problems that might happen in the periphery might have consequences over the core even. So core and periphery came together. It was first in Berlin, I guess. And it is, of course, a symbolic city. East and West it touches each other. And then, of course, Financial Stability Forum. Now it has another name, Financial Stability Board, mentioned again a few minutes earlier by Mr. Governor. So we got a lesson from the Asian crisis. First, financial sectors might be problematic or even dangerous, and especially within a globally integrated and interconnected system, you will face serious difficulties. So I want to come to today, and I would like, if you don't mind, to start with Professor Siebert. Ladies first, you know. This is the universal rule. So, Professor Siebert, you know that one of the main agendas of G20 was the international monetary reform. Why do you think that after a financial crisis, it was a financial crisis, we started to discuss about the monetary issues so deeply and so radically, especially? I am sure you heard Mr. Governor. Today, Chinese renminbi is taken as a possible future, maybe, reserve currency. Or there are several other attempts, several other approaches. Obviously, for sure, we will not have anymore, at least in the period ahead, a bipolar dollar-euro type international reserve monetary system. There will be other candidates or other maybe compositions. Why do you think that this become a topic? International monetary system reform. Sorry. Well, so this is, we have a, Houston, we have a problem. Because I was not aware of this. I just arrived from New York, where we discussed heavily those issues. Excuse me. So you want to talk about the price stability?
Well, actually,
Please. Put on.
a surprise. I was told to give a 20, 25-minute talk on managing the twin objectives of price stability and financial stability. So if that's okay with our organizer.
Your names, but okay, go on.
It's an honor to be here in what is indeed a very beautiful financial center. And so indeed, I'm going to speak for a little bit on managing the twin objectives of price stability and financial stability. And then I'm going to finish by talking a little bit about a problem which is very important to Turkey, and that is managing short-term capital inflows. So turning to the objective of price stability, it is likely that someday the benign conditions that characterized the earliest years of this century will reemerge. And then everything that we learned about price stability is going to become relevant again. And what we discovered is that inflation is costly. Central banks cannot systematically affect real variables. Using monetary policy to offset shocks is difficult. And policymakers have an incentive to use monetary policy opportunistically. The 1980s and the 1990s were a time that policymakers and academics gave a lot of thought about how to design institutions to deliver low and stable prices. And what they discovered was that a good way to attain price stability is to make the monetary policymaker operationally independent and to give it an inflation target. And this led to a wave of central banking legislation in the late 1990s that introduced inflation targeting around the world, and also, of course, in Turkey. Ideally, an independent monetary policy committee is given an inflation target, and it chooses a policy rate to meet this target. The specifics of how you design the committee are important. A vast body of social psychology research suggests that if you want the members of a committee to do a good job, you should make the committee fairly small. A good size for a committee that has to solve problems like a monetary policy committee is 5 to 9 members. And you should make it possible to identify the individual contributions of the members. So this suggests that the Monetary Policy Committee should be given a single objective, a point target for inflation. The votes should be published, and the committee should be protected from political influence by making terms non-renewable. Another vast body of research in the social psychology literature suggests that groups tend to magnify the individual tendencies of their members, in the worst case, producing groupthink. And this suggests you want your monetary policy committee to have staggered terms, diverse members, and external members. And as with any seriously important technical task, be it brain surgery or building bridges, it is better to get the best people, not the best people of a particular nationality. Making monetary policy is mainly a technical task, not a political task. And now I'm going to turn to the objective of financial stability. Unlike monetary policy, achieving financial stability is a political task. Central banks have to decide what to accept as collateral, how to value it and haircut it, who to accept as counterparties, and of the institutions which may or not be insolvent, which to accept and keep afloat at the discount window. A central bank that's doing this has to take on risk, and redistribute wealth. Only an accountable body can do this. The citizenry or its agent has to be able to evaluate the performance of the institution, and it must be able to punish the policymakers. Problems in credit markets may stem from adverse selection problems related to asymmetric information or from contagion. And macroeconomists, the people who tend to populate central banks, they are not natural experts at this. One wants the Financial Stability Committee to be made up of microeconomists, people who are experts in the field of money and banking, research accountants, and recent practitioners who actually might have known what a collateralized debt obligation was. The problem then is that providing price stability and providing financial stability are tasks that require quite different expertise, and they need different institutional design. That is, they require different levels of accountability. So I have the following suggestion. Make the central bank an accountable institution that's staffed with people with expertise in the field of financial stability, as well as a macroeconomic staff that can provide forecasts. As in the case of Iceland, the Monetary Policy Committee should be affiliated with the central bank, but distinct from it, and charged solely with selecting a policy interest rate with the intent of achieving a statutory, and this is important for Turkey, rarely changed inflation rate. I suggest a 7-person committee. The Turkish Central Bank's Monetary Policy Committee is the perfect size. It should be populated with 3 internals and 4 externals. The main requirement for membership should be competency in macroeconomics. With externals outnumbering internals, it's not so important who the chairman is, and it's not even necessary that the chair be the governor of the central bank. The Turkish policy of allowing the committee to set its own rates and varying them from year to year is not appealing. A policy rate of 4% in one year, followed by 7.5% a year later, is unlikely to ensure a reputation for inflationary toughness. Financial stability should be decided by a separate committee within the central bank, chaired by the governor. The intersection of the 2 committees should be small, maybe just 1 member. The governor and the committee should have a mandate to make risky decisions that might redistribute wealth if the stability of the financial system requires it. And they must be held accountable. This committee has to say what its collateral policies are and how they decide them. It must say how it chooses its counterparties. With an appropriate lag, it should provide the details of its transactions. Members must testify regularly before Parliament. None of this ECB quarterly dialogue with Parliament. The main requirement for being on this committee, other than having a reputation for being above board, is an expertise in financial markets. I think the Turkish central bank is missing the point when it says, quote, the central bank approaches financial stability from a macro perspective, unquote. So how would this 2-committee system have worked in practice in not so benign circumstances? Say, the stock market collapse of 1987, the Russian default of 1998, the tech bubble crash of 2001, or the onset of the August 2007 liquidity crisis. When monetary policy committees were in charge, staffed with macroeconomists, what they saw was the rise in interest rates. And their solution was to douse the market with liquidity against high-quality collateral. If instead you'd had a financial stability committee populated with experts in financial markets, what they would have seen was the evaporation of liquidity. And the cure for this is not additional liquidity against high-quality collateral. It's to make a market for the illiquid assets so that they can be used as collateral, or to value these assets and haircut them for their illiquidity and then accept them as collateral. And of course, by doing this, the central bank takes on significant financial and reputational risk. And only a body with a political mandate allowing it to do this can do it without losing legitimacy. So it's a task for a fully accountable Financial Stability Committee rather than an independent monetary policy committee with limited liability. What about quantitative easing? Suppose that the interest rate is near zero and that the central bank can't make monetary policy by lowering the policy rate any further. The central bank might instead then make monetary policy by purchasing home currency denominated government bonds with the intent of increasing the monetary base. Theory and practice tells us this doesn't work very well. When the interest rate is near zero, the private sector is saturated in its holdings of money, and it regards money and government bonds as near perfect substitutes. So quantitative easing isn't likely to produce any change in nominal variables, and consequently, even if it's unanticipated, it's not going to produce any change in real variables. What if you did it and added a twist? If the short-term interest rates are near zero and the long-term rates are not, a central bank might expand its holdings of low-interest-bearing short-maturity government debt and then swap this debt for longer maturity government debt with the thought of driving down longer-term interest rates. Unfortunately, as long as markets are efficient, theory tells us this isn't going to happen. The government, the central bank, is the sole issuer of money. So the price of money depends upon the central bank's supply. But any institution, firm, or household can issue debt. And as any debt issued is one party's asset and another's liability. Its net supply in equilibrium is always zero, and the price isn't going to depend upon the amount issued by any one party. Nevertheless, a desperate central banker is going to want to try these policies. And as they're sufficiently technical activities, under the category of clutching at straws, they could be delegated to the Independent Monetary Policy Committee. Qualitative easing, however, that is expanding and then changing the liquidity or risk composition of the central bank's balance sheet, can redistribute wealth. And this is a political activity that's appropriate for a Financial Stability Committee, not a Monetary Policy Committee. What about Swiss-style easing? Recent turbulence has caused Switzerland to be the recipient of safe haven capital flows. In normal times, these capital flows are deflationary, and an inflation-targeting monetary authority would cut interest rates. But Swiss interest rates are near zero, so the Swiss Monetary Authority is responding by offsetting these capital inflows by purchasing foreign currency-denominated assets. In this situation, you have to feel some sympathy for the Swiss. The current disarray is likely a fear-driven outcome in a scenario that has multiple potential outcomes, and the euro area policymakers are not doing enough to quell market fears. The Swiss are forced to react. But this is qualitative easing, and this is an activity best done by the Financial Stability Committee. But this raises the question of what is a central bank to do when faced with capital inflows that cause its currency to appreciate. Big and little countries face different problems. When the US announced a new round of quantitative easing in November 2010, the world reacted in horror. The former Federal Reserve Chairman, the prime ministers of Japan and Germany and assorted officials from Brazil, China, and elsewhere accused the US of trying to follow a beggar-thy-neighbor policy. This was a bit over the top given the likely success of the enterprise, but nevertheless, any successful monetary stimulus has a beggar-thy-neighbor component. Home competitiveness is increased at the expense of the rest of the world. Still, using quantitative easing or interest rate policy to stimulate your economy is reasonable. Policies aimed directly at the exchange rate may be unfriendly and lead to bad relations. If all countries follow them, we see what can happen from the experience of the 1930s. In a sufficiently sizable country, a policy aimed at increasing competitiveness at the expense of the rest of the world has foreign policy implications and should not be left to a monetary policy committee, certainly, and probably not even just to the central bank. For smaller countries, disruptive capital flows make monetary policy challenging, to say the least. So what can be done? Fixed but adjustable pegs usually lead to tiers and new finance ministers. Currency boards can be a somewhat safer and temporary option for small countries, especially if they, say, intend to join the euro area, but they too can require an unrealistic amount of credibility. And if adhered to, a country is unable to act as a lender of last resort for its banking system. And even if they work, exchange rate stability does not necessarily imply price stability. Very small countries, such as the one on whose monetary policy committee I sit, should consider giving up their own currency. A country such as Iceland, that's the size of Aurora, Colorado, should not have its own central bank. Making monetary policy is too big, and it doesn't have the resources to provide all of the trappings of government. Monetary policy can be farmed out. For in-between countries such as Turkey, the only real choice is between adopting another currency, such as the euro, or floating. Benefits of floating, which is what I think I would advocate, are being able to act as a domestic currency lender of last resort to the banking system, and being able to pursue an independent monetary policy. A cost, as we see, is probably a significantly larger potential inflation bias. In addition, a float produces potentially faster price adjustment than a peg, as exchange rates are set in financial markets, and prices and wages are subject to a host of rigidities. But the interaction of a floating exchange rate with sticky prices and wages can lead to undesirable outcomes, such as the overshooting of real and nominal exchange rates. In addition, economists have been successful in explaining only a small part of exchange rate movements in terms of fundamentals. The rest might be influenced by imperfect rationality, such as myopia or herding, and any financial asset price can be the result of self-fulfilling fear or exuberance-driven beliefs. So imperfections and multiple equilibria in foreign exchange markets can cause exchange rates to be an independent source of volatility. Inflation targeting in small to medium-sized countries is inherently difficult, and there's just not much that can be done about it other than to promote wage and price flexibility and to supervise and regulate the banks properly. Turkey's well-capitalized banking system and a lack of foreign exchange exposure on the part of banks and the rest of the private sector should have made it well-positioned to weather the global financial market turmoil. And the policymakers, the monetary policymakers, have certainly showed ambition and creativity, but their experience suggests monetary policy can only do so much. Monetary policy, at most, can be used to ensure low and stable inflation. It cannot also be reliably used to smooth exchange rate fluctuations, moderate the carry trade, control overshooting, and stabilize the current account. My suggestion is to plan on reducing the inflation target from its too high level once and for all and meet it. I know this sounds really obnoxious coming from someone from the Central Bank of Iceland where we haven't met the inflation target in years, but it's always more fun to analyze someone else's problems. Inflation that may reach well over 8% by the end of this year is not good. The policy rate should be raised to reduce inflation to target. Delegating policy rate decisions, and only policy rate decisions, to the MPC could help ensure that monetary policy is not viewed unrealistically as being able to solve more problems than it can. Finally, other policy measures could be used to deal with the other problems. Tighter fiscal policy would allow the central bank to meet its inflation target with a more sensible policy rate and lower real rates. Reforms that increased price and wage flexibility would reduce the risk of exchange rate overshooting. And currently, an increase in demand brought about by short-term capital inflows results in imports going up instead of output. And this is not something monetary policy can solve. Deep fundamental reforms are in order. Turkey currently ranks 65th in the World Bank's Ease of Doing Business rankings, just edging out Ghana and Belarus, but worse than Kazakhstan, Oman, Romania, and Rwanda. Reforms would ensure that businesses could respond more flexibly to demand and that currency inflows would result in increased output rather than a current account deficit.
Well, thank you, Professor. You really described the domain in details, though I have several objections, but I keep in reserve. I am sure from the Q&A session we will have time, maybe with floor as well, to discuss those issues more in depth. Now I would like to move to Deputy Governor of Central Bank of India, Reserve Bank of India, Mr. Khan. And I think he has a presentation, so please, floor is yours.
Governor Dr. Baski, Professor Murat, Deputy Governor Dr. Turhan, Professor Anne Sibat, Mr. Kolasa, ladies and gentlemen. It's a great privilege to be in the historic city of Istanbul, which is often referred to as cradle of civilizations, and very nice to hear about a beautiful dream of Istanbul 2023 from Governor Dr. Baski. This is my first visit to Istanbul, and I was really impressed by the dream which he laid out before us. In fact, this is a city, as I told, is a cradle of civilization where histories has been made, and this city has seen histories after histories, from Constantinople to its present phase of Istanbul, and we are having this very historic summit when histories are being created, histories are being destroyed, and histories are being recreated. I think as Dr. Turhan was mentioning, this is a confluence of East and West, maybe confluence of developed countries and emerging market countries, and that confluence of experience, I think, is what is needed when you want to tide over this crisis. Since we have running short of time, I have some presentation slides. I will skip through some of the slides, but maybe I'll try to focus on some areas which, as Dr. Turhan was telling, maybe somehow contradictory to what Professor Sibet was telling. the point, let me start with the point she mentioned about the mandate of central banks. I think the mandate of central bank is beyond monetary management alone. And we are telling from our own experience in India, from experience of emerging market economy, because it can't be only one responsibility of the central bank. There cannot be no single objective and no single instrument, ignoring what is happening in the entire macroeconomic field. And we need to have a broader macroeconomic view. And there could be conflict of interest when you try to do so many things, but you need to bring out some harmony in those conflicting objectives, whether it is price stability versus financial stability, where you talk about microprudential supervision versus systemic risk management or prudential management, and which now coming to the fore post what is happening in Greece, sovereign debt management, monetary policy, and financial stability. The role of central banks as it has evolved how the economy has evolved, it has evolved the way the financial sector has evolved, and the way the entire financial system is undergoing crisis after crisis, and there are new responsibilities being added to the role of central bank. We are now seeing central banks have been asked to get into growth objective in a big way. She was referring about Operation Twist. There are central banks who have unemployment removal objective, regulation and supervision of financial institutions, financial markets, and financial market infrastructure. Sovereign debt management I referred to, financial stability of course, and which Governor Vasky referred to, financial inclusion, financial literacy, financial education, and other objectives. The whole idea is that innovation is one part, but first in countries like developing countries, emerging countries like ours and Turkey, the whole issue is providing basic banking to the entire population of the country, providing financial education to the population, and providing what is called no frills or less frill banking. So that itself is a big challenge, and of course innovations do help, but innovations not at the cost of basic banking. There have been now this global financial crisis, which we thought has ended, in fact is recurring, and the role of central bank in prevention, management, and resolution of financial crisis has come to the fore, and how the central banks acts and reacts with other bodies within the country and across the country is of great significance now, and the issues of central bank governance, accountability, and autonomy also has come to the fore. Just to juxtapose with that, the way the role of Reserve Bank of India has evolved as a major central bank of an emerging country, we have always had multiple objectives: price stability, growth, financial stability. Though it is not provided in our statute, in practice we have been doing, and since 2004 it has almost become an explicit mandate. And we are a full service central bank providing all services, including regulation and supervision of banking and non-banking sector, key financial markets, foreign exchange management, public debt management, and financial market infrastructure. And what we have observed that this synergy does help in handling diverse roles. So that is why we never thought that we should be bogged down with a single objective or a single instrument, because that will entail huge risk to the system. In the context of global financial crisis, there has been wide-ranging reorientation of central banks' mandates, both in terms of price and financial stability, systemic approach to policy and macroprudential policy, sovereign debt management and monetary policy, which I referred to, and the huge issue of capital flows, and the issue of accumulation of reserves, liquidity management, and payment settlement system, which often is missed sight of, and the issue regarding the regulatory infrastructure and what role central banks will play along with the government and other agencies. I'll touch upon each of these items very briefly. Let me come to price and financial stability issue. We believe, we have seen in our practice, they really complement and supplement each other. But there could be trade-offs. Sometimes stable prices and low interest rates can incentivize underpricing of risk, which is one of the contributing factor to the crisis we have seen. And there is a time horizon issue. Financial stability has a longer policy horizon, whereas price stability could be a short-term issue, but they can be managed if they are managed carefully. So, in fact, there is serious rethinking whether the central bank world over should only be pure inflation targeters. The systemic approach to policy is the second issue which I was referring to. The pre-crisis, as all of us know, was focusing upon stability of individual institutions. Now the whole focus is shifting to systemic stability, both in terms of its time dimension and cross-sectional and interconnected dimension. In fact, it's a leap from bottom-up approach to a system approach. There are strong complementarities in macro and microprudential policy frameworks. The tools are broadly same. For example, core capital prescriptions, leverage ratio, expected loss provisioning through the cycles. So they are broadly the same tools. But there could be potential trade-offs because there are two sets of purposes which Professor was mentioning. For example, macroprudential policy may require that as a counter-cyclical measure, you should release the buffer, whereas the microprudential aspect will warrant that banks remain well capitalized as much as possible. But if there is a continuous interaction, exchange of information, this trade-off can be managed, as you have seen in our case, as I will just briefly mention about our experience. As I told you, it was not our explicit objective, not even our statute, but in practice we are following, more particular since 2004. We are in charge of macroprudential and microprudential of both banking sector and non-banking sector, management of capital account, as well as important financial markets and financial infrastructure. And as I told, these synergies help us a great deal. There is an issue of how do we take care of leverage entities within our regulatory framework. We have followed a sequential approach. As in the morning, the minister from UK was mentioning that too much of innovations may not be good. In fact, Lord Turner some time back was referring that the focus should be on basic banking, which I was telling, and there is no greater innovation than what has happened in the form of automated teller machine. So that is what, but we need not go to that extent, but then what we are trying to do is balance between innovation and stability, and that balance has to be certainly struck within a prudential framework, and we have followed a sequential and calibrated approach. And what people have been talking about perimeter of regulation, talking about shadow banking, we have also tried to focus on non-banking sector because you may well regulate the banking system, but the balloon could puncture somewhere else. So we had tried to see that these non-banking entities are properly regulated and there is a framework for their systemic assessment. And we have also tried to see how this conglomerate supervision can be built into our framework. For example, for this interconnectedness, what we have tried to see is that there are prudential limits on the interbank liabilities, higher risk for banks in the subordinate debts of other banks, restricted access to uncollateralized funds, and exposure limits are fixed for banks and non-banks. That's how I try to address interconnectedness. The systemic risk identification, of course, we have now in a very systematic manner we are doing. Earlier our approach was ad hoc and judgmental. Now we are trying to put it in a framework, broadly drawing upon what is happening elsewhere. For example, we have now a dedicated financial stability unit within the central bank. There were some issues, who should be the responsible for this financial stability unit. More or less the debate has settled in India, though there is an inter-regulatory agency, but this financial stability in RBI, in Reserve Bank of India, will be collating the stability macroprudential aspects from all regulators, and we are bringing out financial stability report every half year. And internally we are preparing quarterly assessments for our internal use and sharing with other regulators. This focus of this financial stability unit and financial stability report is, in fact, it is evolving, and we are focusing on fiscal financial stress indicator, which is basically talking about, then we have banking stability indicator, which we are very closely monitoring. The banking stability indicator broadly focuses on 5 areas: soundness of banks in terms of their capital adequacy, their leverage ratio, we're talking about asset quality of the banking system, the liquidity and aspects of banking system, their profitability, and the efficiency of the banks. So this goes into the banking stability indicator. Then we also have this fiscal stress indicator to assess the fiscal risk, systemic liquidity indicator, as well as network model to capture these interconnected issues. This is what our financial stability unit is now working on. We have under this banking stability indicator what is known as toxicity indicators, how one unit can affect others and how one unit can get affected by others in terms of vulnerability index. So these are some of the work we are doing. They're still in the preliminary stage, but quite a few things we have been able to do now. The other important issue which I thought is assumed importance in the context of what has happened in the field of sovereign debt. In fact, the earlier crisis of 2007-8, the financial sector crisis moved to real sector, real economy was affected. And now what has happened, possibly, the public sector crisis has got into the financial sector. So that is why the sovereign debt management is a very critical issue in the context of monetary policy making and stability, financial stability. There was almost, before the crisis, the almost settled ideology or orthodoxy was that debt management and monetary management should be separated because there is a conflict of interest. I think this sovereign debt crisis has brought that we need to relook and rethink the whole old ideology of separation of debt management from monetary management. In fact, in early 60s, 1963 to be precise, Tobin has said that debt management lies at the heart of monetary management. You just can't, they are not divisible, particularly when the debt is very high. And Governor was mentioning about Staket's paper in Jackson Hole about the public debt. When the public debt is going to be huge, you just can't leave it to a separate, small, independent outfit to handle this debt management, because it has to be realized that debt management or the debt public borrowing, when it is very large, has implication for interest rate, has implication for credit growth to private sector, has implication for the systemic liquidity. And if you give it to a small debt management outfit, their incentive structure could be different. They could be focusing on short-term interest. There will be huge rollover risk, and there could be possibility of your domestic debt being overexposed to the external debt, external investors, and creating problem of sudden stops and volatility. So the central bank has to get involved in debt management wherever they are not there, and wherever they are there, they need not be disturbed. In fact, in Indian experience, the big debate is going on in India that we should have a separate public debt management office. In fact, our views have been that there is no need for that. There is need for coordination. Please don't fix which is not broken and which is working well. And the world experience has indicated that there is confluence of interest when sovereign debt management, monetary policy, and financial stability, all the three objectives work together under the aegis of the central bank. In fact, possibly the last word has been said by, may not be the last word, by Charles Goodhart, when he says that debt management should come back to central bank wherever it has not happened. So this is the context of this so-called impossible trilemma. Now the other issue is of capital flows. Capital flows is one issue where central banks have to got involved because it has a implication for financial stability. And we need to see that developing countries do need capitals, but there are risks unless they are closely monitored. And as the financial crisis indicated, there could be reversals and volatility in flows, and these flows can go to sensitive sectors and create havoc in the real estate and asset price bubbles. And that is why we need to have a coordinated approach, so no country can think itself bigger than our policy and go on doing something which will have implications for others. So there are many of policy options for handling these capital flows. There could be floating exchange rate, which he was referring to. There could be adjusting interest rates. There could be fiscal policy measures and capital controls, which was a taboo till recently. Now it has been accepted that capital control can be considered when there are serious issues. And in fact, if I give you the Indian experience, we have been following active capital account management policy. We have, but we have followed a calibrated approach both towards inward and outward flows, whether it is inward investment or outward investment, whether external commercial borrowing or portfolio flows, and our approach has been to discourage debt flows, short-term flows, and grow for long-term flows. And the whole issue of forex intervention only to see if there is a excess volatility to curtail that, but we was always looking forward to other policy options of currency flexibility with continuous development and strengthening of the domestic financial sector so that the flows can be managed and equilibrated in the system. The other issue which is being talked about is of accumulation reserve, bad policy or good policy, how much, to what extent. I think this debate cannot be settled so easily, but the point is whether there are other options other than self-insurance. We have IMF, now we are seeing IMF itself is stretched, and we have regional arrangements which was being Chiang Mai initiative, which was being foo-fooed, but now in the European context also, regional arrangement and IMF, they have to work together. I think the point we need to accept that reserves do work as a self-insurance whenever there are sudden stops. I think that we need not be very ideological about holding reserves. They do provide buffer to developing countries. The other issue is of liquidity management. Central banks have to get involved very actively into liquidity management. We have seen the experience of developed central banks, and similarly the case with developing central banks, because we have in our own experience seen we have used large number of conventional and unconventional policy to take care of liquidity, both domestic liquidity and external liquidity. But we have never tried to do it by expanding our balance sheet and without diluting the quality of collateral. For that, we need to take preparatory steps. The other issue which is quite often missed is this payment and settlement system, the role of central bank. I'll just touch upon one area, is what is the role of central banks, whether it can provide liquidity support to financial market intermediaries like central counterparty when they're in difficulty. I think this issue is yet to be settled, but at this stage one can say that we should have legal provision of providing liquidity support to systemically important financial market intermediaries without explicitly stating so. In a sense, we should have a policy of sort of a ambivalent clarity about financial market intermediaries, because it could create huge crisis in the financial market if they are not supported at the time of distress. Then the issue of this regulatory infrastructure, I don't want to get into that, I have broadly covered. I'll just touch upon one area. This financial stability, of course, is an issue which has to be shared between all the regulators within the country and, of course, outside the country. And in our Indian experience, we have now seen that this does help. There has to be need of coordination between the central bank and other regulators. And of course, if there is a coordination, there is a possibility of some sort of political interference, quote unquote, because as has been said, that a macroprudential's objective is to take away the punchbowl, particularly when you see there are systemic fault lines appearing. But there could be different connotation from political side, the judgment could vary, but then we can't, because of that, we can't shy away from responsibility of taking the responsibility of managing financial stability. Of course, we have seen this coordination. During the crisis, the coordination has come to the fore, because the fiscal, in some sense, is the lender of last resort during the crisis. And now there are coordination councils coming in different countries. In our own country also, we have now set up what is known as Financial Stability and Development Council, which is chaired by the finance minister, and other regulators are there. Under that, there is a committee, subcommittee, which is chaired by the governor, the central bank, the Reserve Bank of India. This is in an evolving stage, and we believe the years to come, this will work very efficiently. And the whole idea is that FSDC at the highest level, at the political level, should get activated during war time, that is huge crisis time, and where the peace time, the subcommittee under the governor of the central bank should be more active. This is the way we are evolving our approach to financial councils. So what are the challenges and way ahead? The last two slides, I'll just quickly go through one or two main points. We have this challenge of implementing macroprudential policy framework. How do we calibrate it, particularly countries like EME, For example, they say that you need to look at credit to GDP ratio. Governor was mentioning that in Turkey, the credit to GDP ratio is low. Same is the case of India. It's between 60 to 70% credit to GDP. So can you look at that credit growth indicator in emerging market context while implementing macroprudential policy? I think they need to be adapted. Then there is, of course, issue of international cooperation and coordination. That doesn't mean the whole, as the finance minister, as the minister, UK minister was telling about some common uniform approach with local flexibility, because that is very important. For example, in the West, the thing was you allow free run for securitization. If each country has allowed that sort of free run, for example, we didn't go for that sort of huge opening for securitization. Then each country had gone for that sort of quote-unquote uniform regulations. You can imagine what could have happened. So there has to be a consensus on the sound principles of regulation. There has to be uniformity, but there has to be some flexibility to take care of a local requirement. Then the other issue of how do we communicate and how do you establish credibility of our policy. The last point, the slide I want to mention is that the period leading to the crisis, central banks were at the peak of their credibility and reputation, because everyone thought that the inflation has been vanquished and there are no major problems, and everyone has declared victory. But crisis had dented the credibility and reputation of central banks. In fact, when Queen questioned the economists, if UK, why didn't you see that crisis was coming? She was also in a sense referring to the central banks in charge of the economies. So we have now learnt our lessons, and in fact we are learning our lessons in a very hard way, central bank community, and notwithstanding this critical role we should be playing, there is a need that we strengthen our policies, we strengthen our processes, and very critical, we need to develop our manpower to take this crisis, the learnings of crisis, into our own practice. So the challenge is how do we rise and deliver the greater responsibilities without creating undue optimism, because there are certain problems, real economy problems, which central bank cannot solve, which Professor was referring. We must also understand the limitations up to which the central bank can work. But of course, we have an opportunity to rise beyond our narrow mandate and establish our credibility. The whole idea is that no crisis should be wasted. Thank you.
Thank you, Mr. Khan. As you may see, India is a very big country that has many richnesses, many colors, and also many inspirations. So Mr. Deputy Governor has just brought a quite different angle. So the debate is already here. And now I would like to turn to Mr. Kolasa for his speech, please.
Okay, thank you. So first of all, I would like to thank the organizers for inviting me here. And in my talk, I will touch upon one important challenge facing central banks in emerging markets, more economies. I mean, just boom-bust cycles related to foreign capital inflows. And in my speech, I will mainly focus on some lessons that can be learned from the recent boom-bust cycle in the Central and Eastern Europe. I mean, the cycle that started nearly a decade ago and just was finished with the onset of financial crisis. Some developments that could be observed there were certainly region-specific, because most of these economies, I mean, in Central and Eastern Europe, are considered as runners-up to the Eurozone, but still I think that some more broad lessons can be learned as well. So basically in the CE region, deepening financial integration facilitated credit expansion that eventually led to a boom-bust cycle. And what was quite characteristic was that this overall credit expansion was to a large degree driven by expansion of loans taken from abroad, and in particular loans denominated in the foreign currency. And also these loans were basically financed by short-term wholesale funding. So this was also something very characteristic, which also could be considered as a kind of recipe for a disaster, for an economic disaster. So there are many factors behind this increased capital inflows into this part of the world, because there was growing presence of foreign financial institutions, there were advances in financial integration, but there were also very low interest rates, in a way teaser interest rates, and also overly optimistic expectations about the prospects of catching up. And finally, what was very important was a very low perception of the exchange rate risk, or even expectations that the exchange rate, that the local exchange rate will be appreciating in the run-up to the euro area. So basically, the link between these huge capital flows and the domestic credit expansion, and then in turn between these developments and the domestic demand expansions were quite clear. Right? Basically, the fastest credit expansion in this region took place in countries receiving the strongest inflow of foreign funds. So there is basically no doubt about that. So basically, the consequence of these kind of developments was something that we may call a kind of pseudo catching up, because GDP was growing really strong in all the economies, but this was mainly driven by consumption and investment growth that was basically not sustainable. And of course, unwinding of these imbalances led to a sharp GDP contraction and deterioration of balance sheets. So basically, like the most trivial lesson that can be learned from that is that financial integration has its perils. It's not only about benefits, but like a more general observation is that the problem in this part of Europe was that financial integration somehow ran ahead of the governance capacities developed by individual countries, but also at the EU level that could somehow curb the macro risk related to this kind of development. So in this respect, as Danny Roderick nicely puts it, it's quite clear now that capital mobility requires quite strong institutional underpinnings, and there are 5 elements to that, like regulation, standards, supervision, enforcement, but also like a kind of lender of last results. So of course, central banks are a kind of natural recipient of these kind of challenges, and this brings us naturally to the concept of the macroprudential policy, which is now becoming increasingly popular. As Claudio Borio put it nicely, we are now all macroprudentialists, right? after the crisis. So it is basically clear that the standard way of thinking about the monetary policy, just organized around so-called divine coincidence, indicating that you can basically output gap stabilization and inflation stabilization can be achieved basically in the same way, just with a single instrument. Now we basically live in a world with many actually instruments and also many goals. The central banks have to get used to this kind of new situation. This is of course quite a complicated new environment, because we know really very little surprisingly little between the links between the financial sector and the real economy. There is now the research agenda trying to disentangle this kind of connections, but we are far away from getting to a kind of consensus that was kind of prevailing before the crisis. So basically, well, what are all these macroprudential tools about? Of course, they are aimed to guard financial stability, but the point that I would like to make is that they can also be used as a kind of part of a macro stabilization policy, just understood in the standard way. So like a kind of standard set of tools of a counter-cyclical policy that the central banks, in a way, are devoted to. This, of course, poses many challenges because it implies that we should somehow respond to bubbles, and of course, detecting bubbles in real time is very difficult. I don't have to probably explain to you that doing this kind of think in a catching up or in an emerging economy is even more challenging when of course it is not clear what the potential growth rate of the economy is. But basically one has to do something about this, and the Polish experience, I think that we have from the recent financial crisis can serve as a good example, because the way the Polish economy sailed through the financial crisis was quite remarkable. At least in the region, we were the only country in the EU that recorded positive GDP growth throughout the whole financial turmoil. And of course, there are many factors behind this, like flexible exchange rate, inflow of EU funds, or timely fiscal stimulus that somehow happened, turned out to be a blessing, even though it was, introduced, so to say, for wrong reasons, right? But what I would like to argue is that like a very important part of this success was this macroprudential policy, because the Polish banking system is basically considered as quite modern, and also the financial markets regulations are considered as quite prudent. And the reason for that is that we have quite a number of very efficient enforcement of solutions. So the banking sector developments are very closely monitored. The enforcement, the timing of legislative solutions is turned, at least so far, has been very good. And also, what is very important, the banking supervision has a very strong position in the banking committee. That's quite important. And so, in this way, using this supervision tools, we managed actually to achieve two important things that somehow helped to insulate us from the crisis. So, first of all, using the so-called best practice rules issued by the Financial Supervision Authority, we somehow managed to slow down the credit expansion, especially the credit expansion in foreign currencies, long before the crisis, the financial crisis. So in a way, we are not in such a bad position in terms of imbalances as many other countries were. And also, actually, our financial supervision was quick enough to impose liquidity standards for banks. That was long before the Basel Committee issued its standards. So we believe that this proved to be very, very efficient in tackling the crisis, and of course we did suffer during that, but not that much as many other of our neighboring countries. And the final point I would like to make is, because of course in a globalized world no country lives in isolation, so you cannot really rely only on domestic supervisionary tools just to ensure that the financial sector is stable and also the economy is more or less on the balanced growth path. And of course we can see some good ideas materializing, especially within the EU. We have these ideas of monitoring macro imbalances. We have this European Systemic Risk Board, and there are some initiatives that are really, well, time will tell how effective they will be, but at least they bring some hope. But what I would like to say also is that not all of these ideas are actually good. Some of those ideas put forward probably go too much in terms of harmonization and ensuring some common standards and also consolidation. And what I have particularly in mind is a new initiative by the European Commission, the so-called Capital Requirements Directive, that tries to impose the so-called maximum regulations principle. In this way, tying the hands of local supervision or regulatory agencies in terms of making the macroprudential tools more adjusted to the local circumstances. And it goes without saying that that even in the EU, the cross-country diversity in terms of financial developments, say nothing of cyclical composition, is so heterogeneous that it's really probably not a very good idea to get rid of efficient and quite independent local domestically oriented financial supervision. And a similar remark can be made on one of the ideas to reduce the liquidity monitoring of financial banks to just to limit it to a consolidated basis. This is probably also something that can be quite dangerous. In our Polish experience, we actually benefited quite a lot from domestically oriented supervision and regulation policies. This served us well, and probably just any ideas tying the hands of local regulators would not be a good idea to pursue. So I will stop at this point.
Thank you. Thank you, Mr. Kolasa. I think we have still a few minutes for Q&A session. Well, for not being another mistake, because I saw some question sheets on the chairs. Should it be written? Is it a very strict rule? No. Now we can take. Okay. So first from the back rows. Yes. I see him. Yes, please. The gentleman back. Do we have micro?
Yeah, they have.
Okay.
Hi, my name is Eylem Ünal from Citibank. First of all, thank you for your contribution for the Istanbul Finance Summit. I have 3 questions, actually, if you allow me. 2 of them for...
Please choose one of them, because there are 3 other questions.
Okay. Then I will ask Ms. Anna Schubert about the Federal Reserve monetary policy. Since the crisis began, Federal Reserve decided to pay interest on excess reserve. So excess reserve balances are quite high, which is $1.6 trillion. Since 2007 August, when we calculated, it's only money in circulation, currency in circulation increased just by $200 billion. It was $800 billion, then now it's around $1 trillion. But do you think that Federal Reserve should lower its interest rate on excess reserve balances? So money multiplier is currently below 1, so it can be above 1, and monetary stance will start affecting real economy much better in this way.
I think, yes, this goes back to what I said about the quantitative easing, that when the Federal Reserve decided to vastly expand the size of its balance sheet because interest rates were near zero, with the hope of increasing the monetary base, the private sector was already holding as much money as it wanted to hold, and it regarded the money and bonds as perfect substitute. So instead of this money ending up in the hands of the private sector, it ends up deposited back at the Federal Reserve. And I'm not surprised that it didn't have much of an impact on the money supply. I'm not sure about the interest rate that they pay on this. Maybe I'll leave that to somebody else to answer. But I don't think changing the interest rate on those deposits would have any effect on real activity, because still the private sector doesn't want to hold the money.
You mean the interest rate is already low enough?
I mean, you could lower the interest rate, which I guess is good from a fiscal point of view, but it's not going to have any effect on the private sector's demand.
Okay, there was another question in the middle. Yes, please.
Thank you. Mehmet Gerz with Ata Portfolio Management. I think it was Mr. Khan who talked about central banks having a role in debt management. Recently, the central banks have been buying government debt. Especially noteworthy is European Central Bank buying Italian and Spanish government bonds. Do you consider this as a ordinary central bank action in terms of monetary policy, or should we take this as a extraordinary action by central banks? Thank you.
I am sure you didn't mean this.
No, I was talking basically in the context of debt management. The point which I was making, which I'll reiterate, is that when the public borrowing, government borrowing is increasing, so it has to be managed. So it has to be managed in the context of both monetary policy and financial stability. So central bank can modulate liquidity in the system so that the huge government borrowing can be handled without disrupting the financial market, without affecting flow to the private sector. So that is how the confluence of interest will work. What you are asking me, that central banks buying government bonds in their secondary market operations, that is a slightly different question, as he said. But as I said, the liquidity management is something you have to use multiple instruments. And in fact, in the current lexicon of central banking tools, never say never to any instrument. You should have multiple instruments in hand.
Last question from the floor, please. Yes. Governor is not constituting part of the floor.
Sorry, my name is Mark Champion. I'm with the Wall Street Journal. I would just love to hear from Mr. Turhan a response to a couple of things that Professor Seibert said. Both were specific to Turkey. One, as I understand it, she was saying that Turkey should really lower its inflation rate target and just keep it steady and keep it instead of changing it every year. And the other was that central banks can only really do a couple of things, control a couple of things, and they shouldn't try and have multiple targets that they try to control, which I think would also apply to Turkey's policy recently, which has been quite complex. Could you address both of those things?
Well, normally, as you can, admit, this is the place to answer by panelists, not the chairman. But I would be glad if during the coffee break we may have a conversation on those issues. Please, Mr. Governor.
Yeah, there.
Actually, actually, I would like to comment about this second question of Mark, not the first question, but the second question. Before he asked, this is for Anne's approach, which is very crystal clear, principles based, to distinguish between financial stability functions and price stability functions, and give the latter, if possible, to the political elected government. So as far as I understand, maybe this could be a question, but as far as I know, in India, you don't have central bank independence. So that's why you can have so many duties, so many tasks at the same time. And that takes away the part of the criticism of Anne from the Indian Reserve Bank of India. Coming to Turkey, in Turkey, our newly established Financial Stability Committee consists of all regulatory and supervisory agencies and the Treasury, and it has to be chaired with the minister to whom Treasury reports. And right now, that's the Deputy Prime Minister is chairing the committee. So that basically addresses Anne's approach. This is in line with the Mexican model. In Mexico, the Financial Stability Council or the committee is chaired by the Minister of Finance. So this is similar to that. So that basically is for the reason that you rightly have pointed out. Thank you.
Can I say something?
Of course.
Often with financial stability, you have to act very quickly. And getting this group of people together is not something that happens instantaneously. If you think of the question that was asked back there about buying the Italian and Spanish debt, this is something, if you had this standing committee and it had the right type of expertise and could identify say, the outcome in the recent market turmoil as being a bad, fear-driven outcome in a case where there are multiple outcomes. It would be a very proper activity for a central bank to intervene in the market and offer to buy up all Italian debt at a sufficiently absurd price. And if they're credible, that will restore calmness to the market. But it's not something that the monetary policy can do because it doesn't have a mandate to take on that kind of risk. And that's what would be very nice to have a standing financial stability committee within the central bank that had a mandate to do that.
But of course, go on, please.
Governor, as I was just mentioning, this whole structure in India also is evolving, and the finance minister is the head of this Financial Stability and Development Council, and all regulators, treasury are part of it. And what we have tried to is it's sort of a review sort of thing. And in fact, it should be more active when there is a real crisis, because fiscal support is certainly necessary, and to establish a credibility that all regulators and government are moving together. That confidence channel gets boosted if this is working. But in no way it should interfere with the operational independence of the independent individual regulators. The point is that something to is if there is a provision, norm has to be established, some counter-cyclical weight has to be established. I will not wait for this committee to meet. I will go ahead and take the action. Maybe I will report back for information. But action should not be curtailed because I am part of a stability forum.
With this, I would like to conclude the panel. Thank you to all, first the panelists for their very valuable comments and views, and then to floor for the very good questions and attention. And I think we have still some 15 minutes for coffee break. Of course, we can continue the conversation and discussion over the coffee. Thank you and good afternoon.